Hey, welcome back. I hope you had a great holiday and a happy new year. Just want to kick off 2024 on a high note. We've got some really positive things here for you. And joining us again is Casey Hazen, one of the CFAs at Horizon. Just want to take some time to kind of break down some things that they've seen as a firm and the things that we have an eye on for you. So, Casey, good to see you again, man. Welcome.
Yeah, Chris, thank you for having me.
Yeah, for sure, for sure. Have a good holidays.
It was great. Got to stay local, so not too much travel, not too much mayhem. So it was exactly as I was hoping for.
That's good. Yeah. I actually got a little bit extra time off this year too. It was nice. But I did have to work. It's the year end.
All right.
So I'm just curious. I am reading and hearing from clients across the board, anything from there's some really positive things coming to election speculation and all of the immigration and China taking Taiwan this year. It's like, I don't think that I've seen such a wide dispersion of expectations. I'm just curious, what kind of things are showing up on y'all's radar?
Yeah. What we're looking for in 2024 is actually for it to be a pretty good year for markets, and broadly speaking for the economy. I think a lot of what you're talking about, some of those potential headwinds that were really in the headlines last year, we're starting to see those kind of fade into the rear view mirror, and maybe potentially turn into tailwinds here in 2024. Some of the things that you mentioned, inflation, I know that we've talked about that in the past. We've gotten pretty positive recent reports from CPI and PCE, which is what the Fed looks at for their inflationary data prints. Those are all trending in the right direction. Maybe we're not back down completely to the 2% target that the Fed has. But again, the direction of inflation is definitely positive, and the Fed is, I would say, optimistic about what they've been seeing. That dovetails really nicely into another headwind that we've been having over the last couple of years, which has been the Fed, and specifically around their interest rate policy. We went from essentially a zero interest rate policy coming off of COVID to this most restrictive 18-month period where the Fed essentially raised interest rates from 0 to 5% over, like I said, an 18-month period. To where we currently sit right now, which is very, very restrictive. And they were, by and large, implementing this restrictive policy stance because of the negative inflationary environment that we were in. So in order to tamp down inflation, they were raising interest rates to kind of cool down this overheating economy as they saw it. Now that inflation is coming more under control, the employment market seems to be normalizing. It seems to be softening. Some of the excesses that we've talked about in the past with the employment market do seem to be, like I was saying, normalizing. So that leaves the Fed in a pretty good position to start to decrease interest rates here in 2024. And that's what we're expecting, anywhere from, call it 1 percentage point, maybe a little bit more over the entirety of the year. We don't know exactly what the number is going to be, but I think the more important part is a loosening of some of that restrictive policy. Again, I think that's going to be very beneficial. If you're in the market for buying a home, it's going to be very beneficial for portfolios, whether it's bonds specifically, or even it's going to work its way out into the equity markets. So again, those were very large headwinds that we've been facing, and we're starting to see those fade into the background a little bit.
What's interesting to me is that last week when we were reviewing all of the models and the assets and things like that, you made a really good point that as those variables and those metrics had continued to cool off, be it inflation or what have you, that the movement of the Fed in 2022, because things are cooling off, is actually becoming increasingly restrictive. So it seems like, if my recollection serves and I'm tracking with you, that the demand will be to see some interest rates actually move back down. And I think the last number that you guys had set out last week was that there's, due to a Fed pivot, there's anticipated as much as 6 rate cuts in 2024. So I think, that could be beneficial, like you said, for real estate fixed income and possibly even equities. So what would you speak to? Because I hear market is overvalued, and man, it's been such a crazy run. Surely we're due for a correction. And then you guys had communicated, you and I last week, but also Horizon, that this is not a normal business cycle. And I think that's really important. Would you be willing to kind of unpack that real quick?
Yeah, absolutely. A couple different points there, but I'll start with the idea that we're not in a normal business cycle. I think everybody on this call has heard of the business cycle or the economic cycle, in terms of, you have an expansionary phase, followed by a peak phase, followed by a contraction phase, followed by, a recovery phase at the very end. And it's kind of this sine wave. And it's very predictable as far as kind of what to expect based on certain economic indicators that, we're seeing in the market. Economists are going to use these economic indicators, whether they're concurrent or leading economic indicators, to forecast where the economy is going. And that's all based on the past 50 to 70 years worth of economic data. That's how economists are going to build their models. What's new or different about what's going on right now is that, COVID essentially broke the economy, at least temporarily, we'd like to say. So if you think about, or a different way to think about the kind of economic environment we've been in over the past 3 years, is not a normal business cycle, not a normal economic cycle. It's been really more of a wartime and post-wartime recovery type of environment. And there are, lots of similarities between, the COVID period and a wartime period, like, going all the way back before a lot of the economic data to World War II, where you had essentially a massive disruption in the employment sector, because obviously, troops were sent off to war. You had a massive restriction or constraint on the supply cycle or supply chain, because again, back then, a lot of the efforts were put into building wartime machinery and whatnot. And then finally, a similarity is going to be massive amounts of government support, fiscal spending, things of that nature that go on in some sort of wartime effort. That all tracks very closely with what happens during COVID. And what you typically see post-wartime, or if you look back at what happened to inflation, more specifically after World War II, it absolutely spiked as, again, the amount of fiscal spending kind of overheated the economy. Supply chains were normalizing a little bit more. People were coming back from war and starting to spend money again in the economy. It creates this kind of overheated economy. And that's what happened with inflation back then. And that's what happened with inflation post-COVID once the economy started to reopen. But also what we saw back in World War II, or the following years of World War II, was a very transitory, and there's that word again that we all kind of hated. It was a transitory inflationary environment that lasted, roughly 2 to 3 years. And if you were to actually overlay the inflationary period following World War II with the inflationary period following COVID, they're eerily similar. So we do like to look at the last couple of years, not as a typical business cycle, but more as a wartime, post-wartime recovery. So a lot of the economic indicators that are normally predictive as to what's going to happen, they're just not as relevant, at least over the last couple of years. But looking forward, we do think that we're going to move back into a more normalized economic or business cycle. This was just a very strange last couple of years, as we all know.
Yeah, I don't think there's much normal over the last few years. Everything seems to be a little bit different. That was actually really helpful when you shared that last week about the post-World War II, and I think it gives context. I think one of the biggest things that we tend to fight in this industry now, you agree, let me know if you think the same. We seem to be fighting these social media engines that generate one-liners, a data point out of context. I know that there's been times where clients have sent me, an email or a text message through the office line and said, "Hey, have you seen this? What is that?" And I don't have the context, and I've sent it to you, and you go, "Well, wait a minute, you're missing these three things, so it's not that bad." But if you just caught the headline and you didn't scratch below the surface, so do you feel like, because you do this for some other advisors, do you feel like you're always fighting that social media one-liner doom and gloom? Let's just, get the clickbait out there, and they're going to read it and forward it to their friends. Do you see
Yeah.
that you guys are contending with that as well?
Yeah, absolutely. There's always a reason to be nervous. Every part of the economy is not always going to be growing exponentially. There's always going to be little bits of the economy here and there that might be under some pressure. But to, expand those out over the entire economy is not always fair. And so context does absolutely matter when looking at some of those. And again, I think as far as clickbait goes, negativity or fear mongering, whatever you want to call it, does sell. It catches your eye. Just emotionally or behaviorally, we're going to be much more attractive to, hey, be nervous about this. But I do think it makes sense to take a step back, think about the fuller picture of your investment portfolio and your investment goals, and think about how, we're currently set up, we're diversified in order to kind of withstand maybe some temporary drawdowns that could potentially happen from any sort of, near-term negative event.
Yeah, that's good. That's good. One of the things that stood out for me was, and I remember it, I don't know, 20 something years ago when I was still at Morgan Stanley. Their research department and trade desk put out these stats about and this is tough and this is not popular, but the person or the political party being elected really doesn't have as much of an impact on the economy as you would tend to believe, that it's actually maybe the Federal Reserve or some of these other exogenous influences outside of the presidency. And so you walked me through, yet again, refreshed my memory after 23 years. Tell the people listening, the clientele and a few friends, what are you guys seeing about, again, it's an election year. Let me see. It's an election year. I don't think people are going to be making a lot of big decisions. I think maybe the first half of the year they'll be willing to make some moves, but I think they're going to start slowing down in the second half of the year. I've been hearing that. So what would you say from y'all's research? And again, I think this is an important election year. I think this is going to be one of the weirdest 12 months, or maybe it's now like 10 or 11 in the history of the United States. But at the same time, what does the history tell us about this election year, and whether you're a blue or a red or a elephant or a donkey?
Right. Yeah. To your point, the data hasn't changed over the past 23 years. It's still telling us the same thing, that who wins the election, whether it's for presidency, whether it's for who controls the Senate, whether it's for who controls the House of Representatives, there is almost a zero correlation between whether it's Democratic or Republican on any of those different fronts and market returns. The market does not really care about who wins the election. There's obviously some caveats to that. There's certain policies that can be implemented on one side or the other that might lead to specific sectors or industries that would outperform or underperform. So I don't want to paint everything with such a broad brush that it's not it's completely irrelevant, because there are some important things that happen from within elections. But generally speaking, the broad equity portfolio that's diversified across different sectors and industries is going to hold up, whether a Republican is in control or a Democrat is in control. And then to your point around, how, like, historically speaking, how do markets fare during election years? And history would tell us it's actually quite well. On average, over the past 50 plus years, during election years, the market is up, and it's up on average around 10%. That's not saying that this year it's going to be exactly up 10%. There's
Sure.
obviously quite a bit of range there. But it is important to note that election years aren't the worst years within an election cycle. The worst year actually tends to be the midterm year, so the second year of the election cycle. But the last thing that I would point out around this year and specifically the election is just that it does tend to be a more volatile year.
Okay.
I think we all kind of know that. If you think about what markets look for, they look for certainty. What is an election? An election is a massive uncertainty event.
Right.
So it's totally understandable that leading up to an election, there's going to be some uncertainty. There's maybe going to be a little bit of volatility. But once that event is taken care of, the market pretty quickly shifts its focus onto what actually matters, and that's underlying company fundamentals and overall economic health. And we do think that both of those, like I was talking about earlier, are trending in the right direction.
That's good. I have seen that, and I would tend to agree, even though I was wrong in some of my assumptions, right? I agreed, man, maybe these things could be negative. I had clients who are very dour and maybe all, rightfully so, but at the same time, if the market goes the opposite direction of how you're positioned, well, we know what that looks like. It's buy low, sell high, not the other way around. So, so that said, Casey, is there anything really positive that stands out for you in this quarter or in 2024, or anything that necessarily negative that's like a headwind that you guys are keeping an eye on, positive or negative?
Yeah, the one positive that I didn't mention earlier in this, I believe it's more specifically focused around equities, but just the reemergence of earnings growth. Over the past 2 years, we've really been in this trend of declining earnings, like specifically for large cap domestic companies. And we, even last year, were in an earnings recession, meaning that we had 3 quarters in a row of negative year over year earnings growth for the S&P 500. Not a very good environment. What we've started to see over the past couple of quarters is modest but positive earnings growth. But what's more optimistic is looking forward throughout the rest of 2024. Analysts have actually been revising higher their earnings outlook. So finally starting to get some really solid earnings growth will really benefit the broad market, but more specifically, it'll benefit some of the underperformers that we saw in 2023. We talked about last time and some of the other calls, this idea of the Magnificent Seven and how 7 mega cap tech companies really drove the majority of the performance for equity markets last year. That's not what we're expecting to happen here in 2024. We do think that it's going to be a broader market rally, and having a more healthy fundamental backdrop of positive earnings growth is really going to propel the rest of the market to, if not outperform, at least perform in line and kind of hold up their end of the portfolio. So I would say on a positive note, that's definitely what we're looking for. And then just some broad risks, because it's not all butterflies and sunshine, as a lot of people like to say around here. Some of the headwinds or some of the risks, geopolitics is definitely something that we're keeping our eye on. What's going on in the Middle East is definitely concerning. The Russia-Ukraine war is definitely concerning for us, especially in the context of the potential impact that those have on the supply chains, just global supply chains, which again could reintroduce elevated inflation, and that scenario would really work against our bullish thesis heading into 2024. But as things stand today, here in January, we put both of those at relatively low probabilities of being kind of wider impacts on the global economy.
Yeah, one of the things that stood out for me as far as a question mark, and I think you guys probably have more depth on the bench to be able to answer it, is that we're already running a pretty strong budget deficit, maybe $1, 2, 3 trillion printed this year in new treasury debt. And you've got these historic trade partners that are kind of backing away from some of those positions, whether it's holding treasuries or dollars or what have you. And so one of the concerns that I saw was that about 7 trillion of our existing treasury debt is going to refinance. And then you've got another, whatever, 1, 2, 3 trillion on top of it for the budget deficit. Was how are we going to get the world to basically help us refinance that much debt? That's a good bit of supply, I would say. And I've
Yeah.
had clients ask me, it's like, well, if you're trying to push out that much and you're a perceived higher risk, what would keep, those auctions from either, fake or, the street, the institutions, the other nations from kind of demanding more from us? And so I don't know if you have a response to that. It's great either way, but I look at it and I say $10 trillion is a good bit of treasury debt to either issue or refinance in 1 year. So my hunch would be that if the Fed knew that, they know exactly the right point to start cutting so that as they refinance that debt, it's going to be in more favorable terms, because sure enough, it's being refinanced higher than it was.
Yeah.
Anything you want to share that?
Yeah, no, absolutely. We're definitely hearing iterations of that across all the clients that we're working with. I would say that one thing that the Fed is looking to do to combat maybe some of the concerns from some of the buyers out there of their debt is they're issuing shorter term debt. I think right now it's a little scary to buy 10-year, 30-year debt from the governments, because a lot of people got burned over the last couple of years, specifically 2022, by owning some of that longer term debt. And then, yes, to your point, governments are absolutely not buying as much of our, external government debts. External governments are not buying as much of our debt. So that does mean that institutions and private investors are going to have to, pick up the slack. But we do think that there is going to be enough demand out there. An area of the market that we think is going to be kind of ready to buy the debt with open arms is going to be some of the more liability-based institutional buyers. So think of that as pension funds, institutions, and endowments, areas that, or insurance companies. Think of these institutions as really trying to match long-term potential liabilities with kind of some of these near-term debts that they're buying. So a 5%, short-term 2-year type of debt instrument for them is very, very attractive. So they're going to be buying as much of that as they can get their hands on. Because if you think about it, 2 years ago, they were also buying 2-year, 10-year debt,
Right.
and that was yielding practically nothing. So they know that the path forward for interest rates seems to be lower. So we do think that they're going to be willing to maybe take a little bit more risk, but continue to buy up as much debt as, like I was saying, as they can get their hands on.
Yeah, I can imagine if they were willing to take it on the chin when interest rates were basically nothing, they would gladly be willing to put some money in, especially with the concept of interest rates falling. That would be an opportunity for them. That's good. Well, Casey, I appreciate you sharing some time with me. I really appreciate also the efforts you guys make to help us be sure that these models are as sharp as we can. I know that I've got some updating to do and just kind of positioning for what 2024 could look like. But I also think that if there's going to be opportunity out there either way, it's just about being able to find it. One of the things I wanted to speak just to clientele is that in 2024, we're going to give you the opportunity to reassess the level of risk. Over the last couple of years, I guess it's almost been 2 or 3 years now of working with Horizon. We've built out basic accumulation models which say you're willing to take risk because you're a long-term investor. We've got preservation models, ones with risk mitigation in them if you're more cautious or if you're closer to retirement. We've now built out a host of cash flow models if you need current income, or if you're at a place where you believe in the concepts of cash flow. People write books just on cash flow assets alone. So we've now created those. And if you do believe that this is a scary year, and there's reason to be cautioned, there's always reason to be nervous, but we also have a capital shelter or a risk averse model if you know that you need to stay invested, but you just don't want to liquidate everything. We've built all of that out. And so I want you to know that we're going to be reassessing your risk and have you go through a series of questions with us to be sure that we are taking the right level of risk. Because if this ends up being a good year, I don't want to talk to you about it at the end of 24 that we were still in a risk averse mode where we could be taking a reasonable amount of risk and hopefully getting some good return for having done so. So I just want to give you that heads up that we're going to be reaching out and being sure that your level of risk is matched to one of these solutions that we've custom made here with Horizon. So that said, I hope you have a great rest of your winter. Casey, I know you're planning your trip this summer for your honeymoon. I hope you guys have a great planning session. That can be fun. And we'll see you again in the second quarter.